You know what's wild to me? The most financially responsible people I have ever met in my life, the ones who clipped coupons for 40 years, who never missed a payment, who kept the same savings account since before some of us were born, those are the exact people getting blindsided by what's happening in banks right now. And I don't mean blindsided like, oh, that's annoying. I mean blindsided like, wake up one morning and you literally cannot access your own money. Money you earned, money you saved, money that is sitting right there in an account with your name on it. So let me tell you about a woman named Carol. 73 years old, retired nurse, sharp as a tack. She had been banking at the same credit union for over 2 decades. Same branch, same tellers who knew her by name. One afternoon she goes in to move some money, about $9,000, from her savings over to her checking. She needed to pay a contractor who was redoing her bathroom, and she had a dental procedure coming up that her insurance only partially covered. She had the money. She'd been building it up for this exact purpose. She sat down with someone at the branch, explained what she needed, and they processed it. Or so she thought. By the time she got home, 30 minutes later, her account was frozen. Both of them. She couldn't pay the contractor. She couldn't cover the dental work. For nearly 3 weeks, she was borrowing grocery money from her nephew. And at the end of all of it, the bank sent her a letter saying the review was complete. No explanation, no apology, just, the review is complete, your account is accessible again. Carol had done nothing wrong, not a single thing. The bank froze her account because the law now gives them the power to do exactly that. And I think a lot of people have absolutely no idea this is happening. Here's what most people don't know, and honestly, I think this is intentional in the way that a lot of financial law is intentional. It's not hidden, but it's buried deep enough that most regular people never find it. Over the past several years, lawmakers across the country have been rolling out something called a safe harbor framework for banks. The idea came from a real problem. Older adults were being financially exploited at an alarming rate. Romance scams, fake grandchild emergencies, investment fraud, you name it. And banks could see the red flags in real time, but couldn't do anything about it. If they blocked a transaction that turned out to be legitimate, they were legally exposed. So most of the time, they let the money move, and people lost everything. So legislators stepped in and gave banks a new tool. Under the safe harbor rules that are now active in the majority of states as of 2026, if a bank reasonably suspects that an older customer is being exploited, they can pause transactions and freeze account access while they investigate. And because the law authorizes that action, the bank is legally protected from liability during the freeze. You can't sue them for the inconvenience. The freeze is authorized. That's the framework. And the category of customer it applies to, they use the term specified adult in most of the legislation, means anyone who is 65 years of age or older. That's the only qualifier. Not account size, not banking history, not whether you've ever had a suspicious transaction in your life. If you're 65 or over, you're in the category. Period. And the hold window is not what you'd expect. We're not talking about a day or two while someone makes a phone call. The standard hold under most state frameworks is 14 to 15 business days. And here's the thing about business days that people don't realize until they're living through it. Weekends don't count. Federal holidays don't count. A 15 business day hold can stretch into 3 full calendar weeks, depending on when it starts. 3 weeks where your Social Security deposits keep landing and you cannot touch them. 3 weeks where your bills keep arriving and you have no way to pay them through your normal account. If you have never thought about what 3 weeks with a frozen bank account would actually look like in your daily life, think about it now, because that is the window written into the law. Now look, I want to be fair about this. The intent behind these rules is not to harm anyone. Elder financial exploitation is a genuine and massive problem, and the people who built this framework were trying to protect vulnerable people from losing everything. That part is real. The problem is the tool doesn't know the difference between a scam and your Tuesday. It's not a human making these calls, it's an algorithm. And the algorithm doesn't know your character. It doesn't know that you've been responsible with money your whole life. It knows what your account looked like last month, and it knows when something looks different from that. Different is enough. So let me walk you through the situations that actually trigger these freezes, because this is the part that matters most. Some of these will genuinely surprise you. The most common trigger is a large withdrawal that comes out of nowhere. If your account has run on a predictable rhythm for years, similar deposits, similar expenses, month after month, and you suddenly walk in and ask for a significant chunk of money, that single transaction is enough to set off the monitoring system. The algorithm doesn't get to hear your explanation first. It just sees a number that's out of character and flags it. The fix for this one is genuinely simple. Before you make any large withdrawal or transfer, call your bank a few days ahead and tell them what you're planning. Say the amount, say the reason, say roughly when you're coming in. What you're doing is loading your explanation into the system before the flag has a chance to generate. Announced money looks completely different to these systems than money that moves without any context. The second trigger surprises people even more than the first, because it has nothing to do with money amounts at all. Banks are now running continuous behavioral monitoring on accounts. And when I say behavioral, I mean they're tracking how you bank, not just what you do with the money. The times you log in, the devices you use, how quickly you navigate through pages, whether you typically call the branch or handle things online. All of that builds a behavioral profile over time, and when something disrupts that profile, it gets flagged. Logging in from a new phone counts as a disruption. Starting to use a payment app you've never used before counts. Making a transfer to someone you've never sent money to electronically, even your own adult child, counts. A change in how fast you type, which might just mean a hand tremor that developed over the past year, counts in some systems. None of those are fraud. All of them can freeze your account. The protection is the same idea as with large withdrawals. If something in your life is changing that will also change how you bank, give your bank a heads up before the change happens. 2 minutes on the phone before you start using a new device or making a new kind of transfer makes an enormous difference. Here's the third one, and this is the one I want you to really pay attention to, because it carries legal risk beyond just a freeze. It's called structuring, and it is a federal crime. And I know that sounds intense, but hear me out, because good, honest people accidentally stumble into this all the time. At some point, a lot of people learn that bank transactions over $10,000 require the bank to file a federal currency transaction report. When they hear that, their instinct is, well, I don't want a federal report filed on my money. That sounds complicated. So they split the amount up. $9,000 today, the rest next week. Under the threshold, no report. That reasoning makes complete intuitive sense. It is also illegal. The law specifically prohibits breaking up transactions with the intent of avoiding that reporting requirement. And critically, it does not matter that the money is completely legitimate. The structuring itself is the crime, regardless of where the money came from. People have had their entire accounts seized over this. Accounts full of nothing but honestly earned, properly taxed savings. Because the withdrawal pattern looked like they were trying to hide something. The counterintuitive protection. Take the full amount in one transaction and let the report be filed. A currency transaction report on clean money is completely routine, and nothing happens because there's nothing to find. The only danger the report creates is when you were trying to avoid it. The fourth trigger is one that operates entirely in the background, without most people ever knowing it's happening. If you have accounts you opened years ago and mostly stopped using, an old savings account, a CD that rolled over, a money market you set up for a reason that no longer applies, and those accounts go without any qualifying activity for long enough, the bank can legally classify them as abandoned. In many states, that threshold is around 3 years. And when that happens, The funds get transferred to the state government as unclaimed property. The money doesn't disappear. It sits in a state fund under your name. But most people never find it because most people never know to look. The protection is almost embarrassingly simple. Log into every account you have at least once a year and make some kind of small transaction. $1 in, $1 out. Anything that registers as activity and resets the dormancy clock. 1 minute per account per year. That's it. The fifth trigger is specific to moving money between institutions, and it trips up a lot of people who are actually being smart about their finances. When you try to transfer money from your bank to a different institution, an online bank, a brokerage account, anywhere that isn't your home bank, the monitoring system treats that transfer with extra scrutiny. It looks at the destination. If it's a bank the system doesn't recognize, in a state where you have no established history, and the destination account is relatively new, those factors together create a pattern that looks, to the algorithm, identical to how stolen money gets moved. The scam version of this transaction looks exactly the same as your completely legitimate transfer to a new high-yield savings account. The way you protect yourself is to move gradually and communicate. Open the new account, move a small amount first, let it clear, then call both institutions before you move anything significant. A phased, communicated transfer looks nothing like money in flight. And the sixth trigger is one that hits people during a life transition they're already stressed about. Updating your contact information, a new address after a move, a new phone number after switching carriers, can itself trigger a hold. The reason is that fraudsters who gain access to an account will sometimes update the contact details before attempting to drain it, specifically to prevent the real account holder from getting fraud alerts. So the monitoring system treats contact updates as a potential warning sign. If you're moving, call your bank before you submit the address change online. If you're getting a new phone number, tell the bank before the update goes through. Same logic as everything else. Anticipated changes clear without friction. Now, here is the thing I said at the beginning that I really want you to have before this video ends. It is called a trusted contact designation, and it is the single most effective protection against a prolonged freeze that exists right now. It's free, it takes one phone call, and the overwhelming majority of people over 65 have never done it. Almost every bank and brokerage in the country now has a trusted contact option on account records. You name one person you completely trust, a family member, a close friend, whoever, and you give the bank their name and phone number. That's the whole setup. What it does is give the fraud department a third option when the monitoring system flags your account. Instead of having to choose between freezing the account or letting a potentially risky transaction go through, they can make one phone call to your trusted contact. Your son picks up and says, "Yeah, my mum mentioned she was making a big withdrawal this week for a contractor," and the freeze never gets placed. Or it gets placed, the call goes out, your daughter confirms everything is fine, and it gets lifted in a day instead of lingering for 3 weeks. Here's what a trusted contact cannot do. They cannot see your balance, cannot access your funds, cannot authorize or block anything on your account. They have zero financial power. They can only answer one question. Are you okay? And do you know about this transaction? That's it. And that one phone call, already loaded into the system before anything goes wrong, is what separates a 3-week frozen account nightmare from a situation that resolves itself in 24 hours. Add a trusted contact today. Call your bank, visit a branch, or find it in your online account settings. 5 minutes. Beyond that, there are 3 other layers worth building. A properly drafted financial power of attorney, not a generic template from the internet, but one prepared by an elder law attorney in your state that your bank's compliance department will actually accept. Give someone the legal standing to act on your behalf if you're ever in a situation where you physically can't advocate for yourself. The second layer is a small account at a different institution entirely. Not because you distrust your main bank, but because if your primary account is frozen, You need a financial lifeline that is completely separate. Even an account with enough to cover 1 month of basic expenses is enough to turn a crisis into a manageable inconvenience. And the third layer is making sure every account you own has a payable on death or transfer on death beneficiary designation on it. Accounts without these designations get tangled in estate administration delays that are, essentially, a different version of the same problem. If you're watching this because your account is already frozen right now, and some of you are, I know that, here's what to focus on in the next 48 hours. Don't spend your energy arguing with the teller or the customer service line. They are not the ones who placed the hold, and they genuinely cannot remove it. Your one goal is to find out which department placed the freeze and get a direct line to that department. Once you're talking to the right people, ask them in writing, what triggered the hold, what do they need from you to release it, and what is the expected timeline. You are legally entitled to all of that information. Then make it as easy as possible for them to resolve it quickly. If there's a family member who can speak to the purpose of the transaction, offer to have them call directly. If an attorney can send a brief letter confirming the legitimate purpose of the withdrawal, that often moves things faster than the standard review timeline. And if the hold extends past the deadline they gave you, file a complaint with your state's financial regulatory authority. You can usually do it online in under 30 minutes, and banks respond to regulatory complaints in a way they don't always respond to customer service calls. Going back to Carol for a second, the reason her story sticks with me is not the money. It's that she did everything a responsible person does. She planned, she saved, she went into her branch in person, talked to a real person, and explained exactly what she needed. And none of that mattered, because she had never added a trusted contact to her account. If her nephew, the same nephew she ended up borrowing grocery money from, had been listed as her trusted contact, the fraud department would have called him on day one. He would have confirmed that yes, Carol had mentioned the bathroom contractor and the dental work, and she would have been home with her full account access before dinner. One 5-minute phone call that she made before any of this happened would have made the 22-day freeze not happen at all. That's the whole point of everything I've covered today. These rules exist. They are not going away. And the gap between the people who get frozen for 3 weeks and the people who barely notice a hold was attempted is not luck, and it's not wealth, and it's not having some special relationship with your bank. It's whether you took a few small steps in advance that cost nothing. The trusted contact is one phone call. The advance notice before large withdrawals is a habit change. Touching dormant accounts is 1 minute per year. A second banking relationship is a small deposit at a different institution. None of this is complicated. None of it is expensive. It's just information that most people were never given. Now you have it. If someone you know is 65 or older and they haven't heard any of this, send them this video. The bank is not going to call them and explain it. You might be the only person in their life who does. And subscribe with the bell on, because this regulatory space moves, and when something changes, you want to know about it immediately. Stay protected.